Well, actually, in terms of the hard data, it's tracking reasonably well. So remember, we came into the year thinking we'd get a flat Q1. We got 3% in U.S. GDP. The second quarter is tracking somewhere around 2%, 2.5%. So I think it wouldn't be unreasonable, given that we think the trend growth rate of the U.S. economy in the long run is more like 1.5% to 2%, for that to come down in the back half of the year. And so I think, we'd expect some deceleration from here. But, in terms of what you're seeing, it's actually quite good.
And with that in mind, and with interest rates where they are, you feel equity markets, all things considered, are reasonably priced?
Well, I think equity markets are going to reflect a confluence of factors, right? So markets have toggled back and forth between the trade war, what the Fed's going to do, and the outlook for growth. And I guess the point is you could have positive news on at least one of those, probably two of them, but probably not all three of them, because the interrelations between those three things. That's what economists like to call a trilemma. And so the idea is that there are guardrails around how good or how bad things can get for global equities, and it puts you in the middle of the distribution, looking for things that perform well in that space. So sources of carry in our multi-asset portfolios, thinking about diversifying underweights in global equities. So whereas it used to be we like the U.S., we dislike Europe, now it's we like the U.S., but we dislike a broad array of economies, trying to diversify out that and reduce the beta exposure in our global portfolio.
Within the U.S., the data weakness has really fallen into the manufacturing space, some of those regional surveys, industrial production. Have earnings come down for some of those sectors?
I mean, earnings expectations for the second quarter are not that high, right? So there's an argument to be made that a lot of that has already made its way into expectations for earnings, which are basically flat for the second quarter. So it's not a high bar to beat. I guess the thing we're watching vis-a-vis the U.S. economy is the spillovers from industrial activity into the services areas of the economy. So last week you had a fairly weak services PMI for the U.S. That tends to bounce around from month to month, but looking through over several months, that does tell you something about the U.S. GDP trajectory. And so I'd be looking for that to stabilize as a sign that you're not getting sort of the good sectors of the economy infected by the bad.
Jay, what's the take from you on G20? Is it just a case of not seeing things worsen from here as opposed to significant improvement in the tensions?
I think there's definitely possibility for upside, right? If there's a deal that comes out of the G20, you could see a broad rally, but barring any sort of landmark agreement, there's very little hope going forward. We're entering into an earnings recession that's likely to extend from Q2 into Q3, and if there's no trade deal on the horizon, I don't really know how people justify continuing to buy into this market.
So wait, we're back in the earnings recession phase? I mean, with markets at a record high, is that in the price?
Not really. I mean, if you see where the markets are and you look at valuations and you expect that not only are earnings going to come down over the next couple of quarters, but there's not a lot of bright spots, then it does start to look more and more expensive.
Ben, U.S. Treasuries attractive for portfolios?
Well, at 2%, it's hard to make the case that you should be backing up the truck to be buying treasuries. At the same time, you have had several powerful demonstrations that this is your late cycle growth shock hedge. And so I think, whereas 2% on the 10-year Treasury is probably near the low end of where we'd expect growth to end up this year and growth pricing. However, you're kind of stuck at neutral because you don't want to be selling in this environment.